Let's talk about partnership taxes. And here are the steps I want you to follow if you are thinking about partnership taxes. It's really important to understand that all partnership owners are required to file specific tax forms every single year. Now, partnerships per se don't pay federal income tax. Instead, the partnership's income, losses, deductions, and credits pass through to the partners themselves, who then report those amounts and pay taxes on them as part of their personal income tax returns. Okay, so this is so you don't have double taxation. You have a pass-through sort of taxation model. Even though partnerships are not taxed, they must file a tax return every year unless the partnership has no income or expense. And so the return will show the partnership's total income, deductions, and credits. And partnerships also must prepare schedules showing each partner's share of the business income or loss. And I'll talk about that later on. That this is basically happening on Schedule K1. And the partners may also have to file state tax returns and pay certain state taxes. Now, whether you operate right now as a general partnership or a limited partnership, you will follow the same basic procedure for filing business taxes. However, limited partners are subject to a slightly different tax treatments than general partners. Okay, so I'll talk about that later on. So here are the steps you need to follow to actually file business taxes for your partnership. The first thing you need to do is to prepare a Form 1065 U.S. return of partnership income. So every partnership must prepare a federal partnership tax return on IRS Form 1065. So on this form, you will be asked to provide the partnership's total income or loss. And so you will also list deductions such as salaries, guaranteed payments to partners, rent, repairs, taxes, depreciation, and employee benefit programs. And your partnership's total income, less its deductions, is basically its ordinary business income. You also need to fill out several Form 1065 schedules. You have Schedule B that includes a series of questions about your partnership, from the types of partners to ownership of corporate shares to types of distributions made. Schedule K is a schedule of income and expenses that forms the basis for the K1 forms you will issue to shareholders. And Schedule L is a balance sheet. Some partnerships also require to complete Schedules M1, M2, and or M3. Okay. Now the return must be signed by a general partner. So this is really important. So step number 1, you need to actually prepare Form 1065. Step number 2, prepare Schedule K1. So partnerships are also generally required to complete a federal Schedule K1. Partners' share of income, deductions, credits, etc. for each person who was a partner at any point during the tax year. And the K1 form lists the partner's name, address, and percentage share of the profit, losses, capital, and liabilities. It then lists actually the partner's share of ordinary income or loss, rental income or loss, and interest income. It also includes the partner's self-employment income, credits, and distribution. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Now, the third thing you want to do here is to file Form 1065 and copies of the K1 forms. Remember, when we talk about Form 1065, we're speaking about an information return. So the partnership is not paying taxes on Form 1065. It's basically letting the IRS know what's really happening. Okay, so partnerships must file copies of the K1 forms with their Form 1065. The filing deadline for Form 1065 is March 15th. The filing deadline for Form 1120, by contrast, is April 15th. Okay, 1120, that's C corporation. 1120S, that's S corporation. 1065, that's partnerships, including LLC. Most partnerships can actually file their forms either electronically or by mail. And also, you have to file state tax returns. So your state may require partnerships to file a state tax return. So depending on the state, partnerships may be required to pay franchise, excise, or other sales taxes. And you can find actually the tax filing requirements for your state online at its Department of Revenue website. And then the next thing you have to do here is to file personal tax returns. So if you are a general or limited partner, you must report your share of the partnership income or loss on your federal income tax return. And the Schedule K1 you receive from the partnership contains the information you need to do this. Okay. And so in addition, if you are a general partner, your partnership's income will typically be considered self-employment income. You will report this on your personal tax forms and calculate the self-employment tax using Form SE. And so because limited partners typically are not involved in running the business, their income is considered passive income. If the partnership actually operates at a loss, they can only use that loss to offset other passive income. In addition, limited partners' income is not considered self-employment income except to the extent that they receive guaranteed payments for services they actually perform for the business partnership. So filing partnership taxes is a multi-step process, and you may want to consult an accountant and a CPA, an EA, or invest in tax preparation software to help you complete your returns. And so to avoid late filing penalties, be sure to comply with federal and state filing deadlines, okay? April 15th, March 15th, and depending upon the state you're in, you also have to think about the state tax filing deadlines. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about partnership taxes. Let me give you a few pro tips here. It's really important to understand that when we talk about partnerships, we're talking about one legal structure, right? Among others. When we talk about legal structures, you're talking about LLC, you're talking about C corporation, you're talking about S corporation, you're talking about sole proprietorship. So after ruling out operating as a sole proprietorship or corporation, you may be wondering which ownership options remain. Partnership is one of them. Now, partnership is just basically, if you will, the collective version of a sole proprietorship. In other words, a partnership is actually treated as like a sole proprietorship, let's say between two or more people. Okay. Now, partnerships are taxed based on the structure that they have. You can be a partnership. By default, you are taxed as an LLC. In other words, you have to file Form 1065. Now you can elect. There is an election that you can actually you can initiate an election to be taxed as something else. You can elect to be taxed as a C corporation. You can elect to be taxed as an S corporation. So you totally have that. But now by default, your partnership will be taxed as an LLC, Form 1065. If you elect to be taxed as a C corporation, you have to file Form 1120. And if you want to be taxed as an S corporation, the form here is basically 1120S. Now, when you have a partnership, it really helps to actually have a written agreement so that everybody is on the same page, especially when it comes to the allocation of profits and losses during tax time. Because see, the thing is, when you have to file Form Schedule K1, Schedule K1 is actually based on a percentage of ownership when it comes to profits, when it comes to losses, when it comes to the deductions, when it comes to all those sort of deductions. So you got to have a clear idea, and it's not about just you. It has to be clear to all the partners what kinds of distributions, what kinds of allocations should be made. And this is pretty great when it's in writing, so everybody's on the same page. Okay. Now, in terms of how profits are distributed in a partnership, again, everything goes back to the written agreement. It's not about 50-50. It really depends upon the contribution of the partner, because some partners are passive, some partners are active, some partners are limited, some partners are general, some partners are just silent. So everything revolves around the initial contribution of the partner into the partnership. But again, you cannot decide how profits will be distributed in a partnership around tax time. No, this is a decision that you have to make way before, and it has to be in writing, and preferably in the presence of lawyers, so that everything is ratified. Everybody's on the same page as to what percentage will be distributed to partners in the event of a loss, in the event of revenue, and so on and so forth. Let me give you the approach to follow if you have to file taxes for a partnership, okay? So everything revolves around IRS Form 1065. I think I've already established that. So everything starts from there and ends with that. But just remember that Form 1065 is an informational return. It's not a return on which you have to pay taxes. The partnership it doesn't pay taxes on Form 1065. The partnership actually informs the IRS and state tax authorities what's really happening in the partnership, tax-wise and also business-wise, because you have to actually also disclose your financial statements. So we're talking about your balance sheets, your income statements, your cash flow statements, and also your statement of owner's equity. So the bottom line here is what? You are painting a picture, a financial picture of your partnership, okay? So everything revolves around Form 1065. And then, so 1065 has several schedules, one of which is really important as Schedule K1. I've already mentioned that. Schedule K1 is kind of important, and how you distribute profits, losses, deductions, and so on and so forth has to actually go back to the pro rata that you negotiated and agreed on with all the other partners, okay? And so when we talk about paying estimated taxes, it's important to understand that this happens at the individual level. It's not the partnership that's paying estimated taxes. It's the individual. It's you. It's all the other partners. So since federal income tax is not withheld from the distributions, individual partners are responsible for their own tax payments. So this is where quarterly estimated taxes enter the picture. So, but how can you estimate your taxes if you don't even have your profit numbers yet? Well, you can use actually the worksheet included on page 8 or 9 of 1040 ES. But if you prefer a slightly more user-friendly method, you just need to actually use accounting software or tax software to kind of help you out. Don't forget to account for self-employment taxes. So most employees pay into the Social Security and Medicare programs through payroll deductions. Partners, on the other hand, do not receive paychecks, so they are required to submit this payment to the IRS in the form of a self-employment tax on their allocated profits. So although this tax is filed along with your annual income tax, it is not taxed the same way. So the self-employment tax rate is currently 15.3% of net earnings of $400 or more. So this rate actually combines both the Social Security and Medicare contributions at 12.4% and 2.9% respectively, okay? So it's one of those things where you have to really be clear as to what really applies to you and what does not. Now, and the catch is that the catch to paying self-employment taxes as partners is that you are paying double. This is because the 15.3% is normally split 50-50 between employer and employee, but without this arrangement, partners are on the line for the entire amount. Fortunately, you can deduct half of your self-employment taxes from your own taxable income to compensate for the added amounts, okay? We are actually preparing another a complete video on Schedule SE, and that will explain everything so you have a clear idea what I'm talking about. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about partnership taxes. Now, let me give you a winner here. And how do you actually report income in a partnership? Well, though a partnership doesn't pay taxes on its profits, it does declare its operating losses and profits to the IRS on the form that I just mentioned to you, 1065. And so in addition to that, it has to send Form K1, right? So that's pretty clear. Now, in terms of you have several instances of profits here. You have distributive shares, you have special allocations, you have other partnership taxes that actually will count here, will actually have an effect upon your income. And so you are also able to decrease your tax burden through deductions, and it's totally possible to do so. Now, let me quickly talk to you about a scenario here when we talk about distributive shares. Whether or not each partner actually receives the amount stated on Form K1 is really irrelevant. The IRS taxes based on a partner's distributive share, which is the percentage of the profits the partner is entitled to. For example, if the partnership agreement states or the partners simply agree that a certain percentage of profits should stay within the partnership, in other words, for example, to pay for expansion or overhead, this doesn't matter to the IRS. The focus is on what each partner's share ought to be. Otherwise, partnerships could retain profits to avoid paying taxes, right? So the distributive share of each partner is actually determined by the partnership agreement. So in the absence of a partnership agreement, the partnership's profits will be split evenly. What about special allocations? Well, a special allocation is when a partnership decides to allocate shares of profits in a way that's different from what's specified in the partnership agreement, or if in unequal shares for a partnership that doesn't have a written agreement. For example, you've been splitting profits equally with your partner, but then decide to split them 60-40 one year. you may do so, but your reason must be for a substantial economic reason. Perhaps your partner took an extended period off to travel and therefore didn't work as much. If it's not, and the IRS determines that the change was made primarily to lessen the aggregate tax burden of the partners, then the IRS will reallocate the special allocation and you will have to pay taxes according to your regular schedule. Okay. Now, special allocation rules are complicated. So, if you have questions, please let us know in the comment section and our team will get back to you. Or even better, you can consult a tax attorney or accountant before making such moves, if you will. It's also important to understand that you always have the opportunity to decrease your tax burden through deductions, okay, through write-offs. You also have the ability to form a corporation. So this could be an S corporation or C corporation, depending upon your strategy, really, if you want to think about it that way. It's really important to understand that when we talk about partnerships, you have several other areas of partnership taxation, right? You have state taxation, you have partnership audit rules, you have special allocations that I just spoke about. You have a complicated annual reporting, especially if your partnerships is viewed as an LLC in the states where you are at. It's also important to understand that a partnership can have or not have flexibility. That's why some partnerships gradually transition to LLC status because they want flexibility. Because again, when you think about a partnership, you're thinking about a collective version of a sole proprietorship. Okay, it's one of those things where you want to really see exactly which status is better for you in the long run. Because it's not just about the short run; it's also about the long run. And when we talk about Form 1065, we're also talking about Form K1, and Form K1 has to be as detailed and complete as possible. The IRS really place an important, if you will, an important emphasis on making sure that the info on Form K1 is accurate. So when we talk about information from your Form K1, we're speaking about ordinary business income or loss, rental income or loss, guaranteed payments, interest income, dividend income, royalties, for instance, right? Capital gains or losses, other business gains and losses, other income or losses, Section 179 expense, self-employment earnings, tax credits, items that affect alternative minimum taxable income, the AMT, tax-exempt income and non-deductible expenses, and distributions from the partners' equity account. So it's one of those things where you have to really make sure that you have the appropriate elements in terms of allocation, but also in terms of transferability. One thing I want to say also is that when we talk about Schedule K1, just make sure that you have to actually send the Schedule K1 way in advance to all the partners so they can file their own personal tax returns. Okay, so because even though the deadline for Form 1065 is March 15th. You got to really send your Schedule K1 maybe around January or February, way long enough for the partners to actually be able to file their Form 1040, which is due April 15th or around that area. One thing I want to mention before closing today's conversation is that when we talk about partnership taxation, you need to understand that you need to have a whole system in place that allows you to file income taxes seamlessly. Okay, so we're talking about filing tax returns. So, for instance, maybe you want to reach out to a tax attorney, you want to reach out to an EA, an enrolled agent, you want to reach out to a CPA, a certified public accountant, to kind of help you file your taxes, or you can use tax software. So the bottom line here is that you can do things manually through a professional, or you can do things through tax software. You have the likes of TurboTax, you have the likes of TaxAct, you have TaxSlayer, you have H&R Block. They all have business versions of their tax software to kind of help you out. So the process or the system you need to have in place in your partnership should allow you to file tax returns seamlessly, should allow you to estimate and pay taxes. Okay, so when we talk about when we talk about estimate taxes, you can do it on a manual, on a quarterly basis, 6 months basis, or monthly basis. And especially when it comes to if your partnership has employees, that means you have to remit all those taxes that you have withheld from employees' paychecks. Okay, and remember that profits are taxed whether partners receive them or not, because the IRS is not really, as I said earlier, IRS doesn't care whether you decide to send your money to Acapulco or you decide to keep it in the company. Whatever it is, as long as income is earned, taxes are due. And you got to have also a system that allows you to establish the partners' distributed shares, okay, and also that allows you to to identify and pay self-employment taxes at the partner level, and also a system that allows you to calculate accurately expenses and deductions. It's one of those things where you got to have a system. Now, a lot of partnerships, what they do, they just use tax software. They just use tax software, or they just outsource the whole tax preparation to a third party. And again, as I said, and you have three categories of professionals that can really file your taxes. I would say with a certain level of confidence. We're speaking about EAs, enrolled agents. We're speaking about CPAs, certified public accountants, and we are speaking about tax attorneys. Just make sure that the tax attorney is licensed to actually practice before the IRS, just in case. Thank you so much for your attention. I really appreciate it. Into this conversation, I was just talking to you about partnership taxes. So I gave you the steps, the pro tips, the approach, the winner, and finally, I'll give you the recap. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.